The screens are quiet, the markets are closed, but behind locked doors, the most powerful institutions on Earth are scrambling because silver just did something it was never supposed to do. The trading week has ended. The charts have stopped moving. Futures are frozen near $80, and for most people, the story ends there. It's a holiday weekend. The assumption is calm, rest, silence. But that surface stillness is misleading. Because if you could step inside the executive floors of Wall Street banks right now, or listen in on the emergency lines running through central banks and regulators, you would not find calm at all. You would find controlled panic. You would find contingency plans being dusted off. You would find emergency meetings that were never supposed to happen. Silver didn't just rise this week, it surged. A double-digit move in a single session. That is not normal volatility. That is not a speculative blip. In a system built on leverage, confidence, and mathematical assumptions of stability, a move like that is destabilizing. It breaks models. It invalidates assumptions. And most importantly, it exposes risk that has been hidden under layers of paper contracts and borrowed money. Silver is not just another commodity. It sits at the crossroads of finance, industry, and currency psychology. When it moves violently, it sends shockwaves far beyond the metals market. A 10% rise is not a headline, it's a stress test. And this week, that test was failed. At the core of the concern is leverage. Banks and large funds do not trade silver with cash sitting in a vault. They trade with borrowed capital. They amplify positions 10, 20, sometimes 50 times over. In calm markets, leverage looks like genius. In fast markets, it becomes fatal. When price moves sharply against a leveraged short position, losses don't grow linearly, they explode. A 5% adverse move can wipe out an entire balance sheet. A 10% move doesn't just hurt, it destroys. That's why the weekend matters. Because markets are closed, but obligations are not. Losses still exist. Margin deficits still exist. And when those deficits can't be met, someone else must absorb them. That someone is the clearing system, the backbone of global finance. Clearing houses guarantee trades. They stand between buyers and sellers and promise that obligations will be honored. If one participant fails, the clearinghouse steps in. But clearinghouses are not infinite. Their protection funds are finite pools of capital contributed by member institutions. As silver prices rise, the notional value of outstanding short positions balloons. Losses compound rapidly. If those losses exceed what individual participants can cover, the burden shifts to the clearing fund. And if the clearing fund itself is threatened, the problem escalates from a bad trade into a systemic event. That is when phones start ringing. That is when regulators are looped in. That is when emergency meetings happen on weekends. This is not unprecedented. History has seen this pattern before. When leveraged positions unwind too quickly, rule books are reopened. In past crises, markets didn't fix the problem. They paused it, reshaped it, or changed the rules to survive. And those decisions were almost always made behind closed doors, outside normal trading hours. Right now, the fear is not yesterday's price. It's Sunday night's open. If silver gaps higher, if it jumps again, when thin liquidity meets anxious positioning, the damage could spread. A sharp upward gap doesn't just hurt the original short sellers. It transfers stress to their counterparties. And if those counterparties include major banks or systemically important institutions, the concern shifts from individual losses to systemic stability. This is why containment is being discussed. Exchanges have emergency powers. They can raise margin requirements. They can restrict position sizes. They can halt trading. They can impose liquidation-only conditions. These tools exist for moments exactly like this. But every tool comes with a cost, and the cost is confidence. Raising margins forces leverage players to either post more collateral or exit positions. It creates forced selling. That can temporarily suppress price, but it doesn't eliminate demand. It simply shifts it. And in today's silver market, demand is not driven solely by speculators. It is driven by industrial users, sovereign buyers, and long-term holders who are not operating on leverage at all. They pay cash. Margin changes don't stop them. Position limits can force large players to reduce exposure on paper exchanges. But capital is mobile. When pressure is applied in one venue, it moves elsewhere. Over the counter markets, foreign exchanges, and physical transactions do not disappear because New York tightens rules. They simply become more important. The most extreme measure, liquidation, only trading, is the nuclear option, allowing only selling while banning new buying guarantees lower prices on that specific platform. But it also destroys credibility. Once an exchange proves it can suspend price discovery, participants begin to question its relevance. Liquidity migrates. Trust erodes. And global markets do not wait for one venue to catch up. That's the trap. Authorities can control paper markets to a degree, but they cannot command physical reality. Silver is a finite material. It must be mined, refined, and delivered. It cannot be printed into existence. If paper prices are artificially capped while physical demand remains strong, the two markets diverge. Premiums rise, arbitrage accelerates, inventory drains. This is already visible. Physical dealers are not lowering prices just because futures pause. They are protecting inventory. They are adjusting premiums to reflect real-world scarcity and risk. The spread between paper price and physical price is not a glitch. It is information. It is the market expressing stress in the only language it has left. Meanwhile, collateral dynamics are worsening the situation. Banks rely on high-quality collateral, often government bonds, to secure financing and maintain leverage. But bond markets themselves are under pressure. Inflation, fiscal concerns, and rising yields reduce the value of collateral at the same time liabilities are increasing. This creates a double squeeze. Losses grow while the tools used to cover them weaken. To raise cash, institutions sell what they can. That selling can spill into equities, crypto, and other asset classes. Not because those assets are fundamentally broken, but because liquidity must come from somewhere. This is how localized stress becomes systemic. A silver squeeze doesn't stay in silver. It pulls liquidity from everywhere else. Narratives inevitably follow. When institutions feel cornered, messaging appears. Headlines reassure. Experts warn of bubbles. Officials emphasize stability. The goal is psychological. If confidence can be restored, selling pressure might appear. If enough holders panic, supply emerges. But confidence is fragile, and in an environment where prices speak louder than words, narratives lose power quickly. This time, the public is watching, not through official channels, but through price action itself. Search trends surge. Physical demand increases. Trust in institutional messaging erodes. When confidence in the system fades, price discovery accelerates. At the same time, producers are changing behavior. Mining companies have endured years of suppressed prices, while paper markets dictated valuations. Now the balance of power is shifting. Physical metal is valuable again, and producers know it. Withholding supply, delaying sales, and negotiating directly with end users becomes rational strategy. Every ounce withheld tightens the market further. Governments are watching too. Major silver, producing countries understand the strategic importance of the metal. Rapid price increases invite political responses, taxes, export controls, reserve policies. These risks are not theoretical. They are part of the geopolitical landscape, and they add another layer of uncertainty for short sellers who assumed smooth, global access to supply. Behind the scenes, unregulated entities face even greater danger. Highly leveraged commodity funds operating outside the safety nets of major banks can fail quickly. When they do, liquidation is automatic. Forced buying doesn't care about valuation or technical resistance. It buys until positions are closed. This is how melt-ups are fueled. Corporate demand adds yet another pressure point. Technology, defense, and energy firms rely on silver. When prices rise rapidly, procurement behavior changes. Instead of buying just in time, companies stockpile. They secure future supply at almost any price to avoid production risk. Those private deals remove metal from public markets entirely, shrinking visible supply. As markets reopen, liquidity will be thin. Many participants will wait to see what rules have changed. That absence of offers means even modest buying can move price dramatically. Gaps become likely. A higher open suggests control has failed. A lower open suggests intervention. But neither outcome resolves the underlying issue. Both paths ultimately point toward higher prices because the physical imbalance remains. Technical levels matter less when history is left behind. Once an asset moves into uncharted territory, traditional resistance disappears. Algorithms rely on mathematical extensions. Human psychology takes over. Attention amplifies momentum. Charts go viral. Participation expands. What begins as a financial event becomes a social one. Retail investors are late, but they are powerful. When they arrive, accessibility matters. Physical metal may be scarce. Paper substitutes may be distrusted. Equities become the outlet. Mining stocks absorb flows. Developers become targets. Valuations rate rapidly. Liquidity cascades through the sector. Psychological barriers like 3-digit pricing matter. Not because they cap value, but because they change perception. Units shift. Behavior adapts. Smaller denominations attract broader participation. Demand fragments but multiplies. Authorities may escalate responses if control continues to slip. Regulatory pressure, taxation, restrictions all become possibilities. Historically, when currencies weaken, alternatives are targeted, but these actions often backfire. They push activity underground. They increase premiums. They reward holders who already possess the asset. Central banks, attempting to stabilize institutions, may inject liquidity. Swap lines expand. Balance sheets grow. Currency supply increases. Hard assets respond accordingly. The paradox is unavoidable. The actions taken to suppress silver ultimately support it. As the opening approaches, key signals will reveal intent and outcome. Gaps, volume, correlated markets. None alone tell the story. Together they reveal whether panic is contained or spreading. For holders, the primary risk is not volatility, it is misreading the environment. Selling scarce assets for abundant currency during a liquidity event is historically costly. Counterparty risk matters. Paper promises matter less than possession. Ownership becomes clarity. If exchanges freeze, spot prices become irrelevant. Street prices emerge. Scarcity asserts itself. Patience becomes strategy. Opportunities persist in adjacent markets. Producers, developers, and companies with real assets benefit from repricing. Mergers accelerate. Reserves gain value overnight. Capital flows where supply exists. Emotion will be tested. Headlines will intensify. Pressure will increase. But this is how structural repricing unfolds, not calmly, but chaotically. This weekend is not just another data point. It is a signal. When emergency meetings happen outside market hours, it means the system is reacting, not leading. It means stress has reached a threshold where normal mechanisms are insufficient. The paper era depends on trust, leverage, and control. The physical era depends on scarcity, utility, and ownership. When the two collide, price is the messenger. The market will reopen. Decisions will be made. Volatility will be extreme. But the direction of pressure is clear. What was once suppressed is now asserting itself. And once that process begins, it rarely reverses quietly. The silence of closed markets is deceptive. Beneath it, the system is straining. And when the screens light up again, the outcome will not just reflect a trade, it will reflect a shift. This is not the end of the move. It is the beginning of recognition.